Hey everybody, Marty Mazzora here, 19th of July 2024 with your weekly video update. Gonna mix it up a little bit today and start with markets and then finish with the economy. In front of you is the written blog post that was sent out to clients on Wednesday morning. So I want to start with markets because I want to reiterate the points that I made here at the top of that blog post, and I titled this one section Small Caps Rally. So we have had a breathtaking rally in small caps since I last spoke to you. We actually had a nice 2-day spike at that point. I think I said in the last video that this may continue, but it's not a time when we get excited about small caps typically. We really don't have it as a target in our core allocation right now. Historically, much of the time we have exposure to small caps. Historically, it's been our tradition, and it will be again, I'm certain, is that we begin buying small caps in some decent size amid recession. That's when we begin to essentially take new positions. Typically, we're out of small caps late cycle, in them relatively aggressively, so to speak anyway, at the beginning of a new cycle or in the early cycle phase. They're smaller ships, they can navigate quicker, and they tend to come off of some pretty notable lows during recession. So while, again, we were rallying, I just wanted to make sure clients understood this was probably not a rally that we were going to chase based on our late cycle view of where things are right now. So this is what I said in the written blog, that again the action over the past week has been, let's say, unusual, at least seemingly, until you look a little further. It certainly bolsters the bullish narrative that this historically bifurcated market, at one point it's my understanding that the 10 biggest S&P 500 stocks literally explained it was like 77% of the year-to-date gains, and that was probably 2 or 3 weeks ago. The Nvidia at one point was about 40+ % responsible for the S&P's gains. That's why the equal weight gap between that and the cap-weighted, the one everybody looks at, has been at a historic wide. And I've shown you that probably a dozen times this year. Okay, so the bulls would say that this is going to be remedied by the rest of the market playing catch up, and of course I'm open to that, certainly plausible. But having done this for 4 decades and studied it constantly, it also kind of looks too much like that late cycle, call it head fake, blow off top, whatever. Not saying that's what this is, but it looks too much like it to go chasing small caps right here. And as I just kind of said a second ago, I'll be a raging bull, but at the early stages of the next cycle, that's just not where we sit right now. And so here I am featuring some research or some history on the Russell 2000. So at the point I wrote that blog post, we had seen an 11% surge over like 4 or 5 days in the Russell. Okay, and then what I show is the 9% surge over the course of a week, right before the market topped in 2021. And then ultimately what we saw thereafter was a 33% collapse by mid-June. Came back off of that, hit it again in the October 2022 bottom. Go back to 2008. Over the course of about a month, we got an 18% surge in small caps. They got sold off, surged again right to that top, call it a double top. And then it was game over. And then by the time they bottomed, more than half of the index went away, essentially. So a 55% drop. And then, my goodness, over 4 months, about 4.5 months, 51% increase. And that was that massive end of the 90s blow off top. And then ultimately to peak right there. And you can see it just turned right back over. And before it was all done, it gave up all the gains plus another 20%. So pretty devastating move, particularly for people who chased this right up in here. So, in closing, again, while we'll remain 100% open to all possibilities, we simply can't lose sight of where we sit in the current cycle. And I'll try to remember to come back to this retail sales commentary I gave right there. Okay, so I want to look at the Russell since then. Okay, so here I wrote that Wednesday, Thursday, Friday. So we've given back, looks like about a third or so of those gains, and we have a big honking gap right here that obviously I'm guessing that gets filled. I don't know. I don't know that I anticipated it this quickly, or that I'm suggesting that this is the beginning of the end. But again, these are just kind of red flags you look for when you see a late cycle market with very extended valuations and what I think is a somewhat sketchy, to put it mildly, economic setup if you have a 6-month to 12-month outlook. Okay, so we'll see how that plays out, but that kind of feeds that narrative that I gave midweek this week. Since we're on markets, let's just go ahead and do the technicals. So I'll jump to the 1-year daily. So folks, I've been kind of characterizing this as a very heavy looking market. We had our rising wedge pattern right here. We broke out of that. That would be your sell signal. Often you get a retest. It didn't quite retest the uptrend line. And then so this was yesterday, and you can see today we're having a pretty rough day. S&P is down 0.81% as we speak. I know the Dow's down a bunch, like 500 points or so, over 1%. Yeah, 450 points. The QQQ, that's the NASDAQ 100, where all those tech stocks are down over 1%. The equal weight index for the S&P is down about the same as the S&P, 0.8%. The Russell 2000 is down 0.58%. Clients, if you're interested, our core allocation is actually down 0.39%, so a bit better than stocks. And that's with gold down 1.8%, which is a not small position for us. So kind of hanging in there. Our options hedges are having quite the day today, and that's mitigating a chunk. We're pretty early in the session, by the way. There's still, a couple hours left in the trading session. So we'll see. We could get some end of week buying as options dealers true up their positions or what have you. But there comes a point where if you fall hard enough, you get what's called a gamma flip, and then it can get worse to the downside. So anyway, those are weeds we don't need to get into today. But so we're hitting right at this 5,500 support. You can see that's very definite support. There was a lot of action in here. We lose that, you're going to have your 50-day moving average, which falls right on another top of a little gap right here. So, we're going to get some bouncing around. We'll no doubt get some rallies. It's a long ways down to the 200-day moving average, and we think in a recession that stocks can go quite a bit lower. And that's, that's over the next 6 to 12 months if that plays out. And by the way, remember I've been flagging this weekly chart as being something that's been near-term concerning. And I've been basically telling you that you don't want to be overbought on the weekly chart on the S&P 500. This is overbought. This is a pretty big weekly down candle right here so far, and the week's about to end. So that's an engulfing candle. Notice here, folks, when we were overbought, this was an engulfing candle. Pretty good decline here in 2023. Here we were flagging this right up in here. I said 5 to 15%. We had an engulfing candle. We were overbought, and we ended up with about a 6% decline. Here, before the 2022 bear market, where we went down 30% or so, peak to trough, not quite overbought. We were a few weeks before. Big engulfing candle, kaboom. So, that's the setup we have right now. Doesn't mean that the market's not going to catch a bid right here at this uptrend line or somewhere around there. But right now, cause for concern, at least technically speaking. NASDAQ 100 index, again, we had this rising wedge, big candle right off of here. I think that engulfs the day before, and falling now down below the 20-day moving average, which has been important on the Qs. Tried to retest it, continuing to fall. Next stop, the 50-day moving average, which is right where we are. Big fat sell signal right here on the MACD. There definitely could be some more downside to play out here. But, we'll get our rallies along the way as well. I'll say it again, in a recession scenario, we think there's a lot of downside before this all plays out. Now, investor sentiment, I pointed at this last time. Now, this has gotten pretty ridiculous, right? This has gotten to areas where we get into trouble. This is the spread between the bulls and bears, a la the American Association of Individual Investors weekly sentiment survey. That's where we were before that 30% drawdown. It's been very stubborn this year. Before we got that 6% correction, we were kind of out over our skis. Now we're back there at real extreme territory. I've mentioned to you how good an indicator the investor intelligence survey of sentiment for investment advisors. And here's that. And when the bull-bear spread gets over 40, you need to look out. Well, it's at 46.9, and that's where it was as of, I think it's Tuesday or Wednesday when this comes out. And again, so you've got huge pile up on the bull side of the boat. You get a spike in yield, you get a spike in the dollar. You know, some would say there's politics in the mix here, whatever. We just know that too many people are on one side, so it doesn't take much to send them scurrying over to the other side. So, you know, correction right here makes a lot of sense. Whether or not this is the beginning of something special to the downside, I'm not saying that. I'm just saying that, you know, some corrective action right here makes a lot of sense to us. So we'll see. Okay, so on to the economy. Our PWA index dropped about 2 points. There was a lot of movement, some good, some bad. Let's start with housing. Home builder sentiment this month dropped to 42, below 50, and the industry is believed to be contracting. These purple and orange are current conditions and 6-month outlook, also below 50, and respective buyers traffic is really down there. So home builders aren't feeling so great. I did read from D.R. Horton's earnings commentary. They've actually been doing okay, but they did say, you know, we're having to incentivize buy down mortgage rates, or margins may get a little squeeze going forward. So they're having to do special things to sell homes. So sentiment isn't great there. That's showing up in single family housing starts. Now overall housing starts are actually up, so we got a kind of a surprise boost in multifamily, which was surprising to me for a variety of reasons. But nevertheless, single family starts, that's what we look at very closely for our purposes as an indicator of the economy. You can see they continue to go down. Single-family permits, which of course are a prelude to where starts will be, have been falling as well. So housing market not looking so healthy right here. Initial jobless claims are a concern. Over the years, I've illustrated for you that you want to look at, regardless of from where the level it moves, but spikes in jobless claims tend to be followed very shortly thereafter with recessions. And it's recession we need to worry about right here for markets, folks. So you're seeing this gradual increase in continuing claims. So these are people who aren't finding new jobs. These are people who are getting fired or laid off as we speak. It's not, historically, it's not a high number. It's just the direction and the rate of change we need to keep an eye on. Another good signal for how the economy is doing, despite the fact that transportation stocks have been doing okay. Probably the most respected metric on freight is the Cass Freight Index. You can see what shipments are doing, and you can see where expenditures are as well. So that's not a really good look from a trend standpoint about the state of the economy. Now, on the other hand, and this would be a concern, the WCI Global Container Index price is really spiking. Okay, so this, save for that stretch, you know, that COVID stretch, this is historically very, very high. Okay, so this is not the kind of dynamic you want to see, particularly if you're the Fed. On one end, we've got, you know, some weakening, and I'll get back to retail sales here in a second, and maybe I'll close with that. You've got some weakening in the economy overall, but then you've got underlying inflation pressures that are still there in certain pockets, like shipping across the world's oceans, right? So that's a concern if you think about margins, right? Because what we're gleaning from earnings calls, and I didn't pull any up this time, maybe next week I will, is that on the retail side, we're really beginning to see stress in the consumer. And yes, it is the lower income consumer that's really feeling the stress. But overall, companies don't seem to have the pricing power that they've had. People just are kind of fed up, and they're not willing to pay these ever-increasing prices, let alone the prices that they've already ascended to, right? So if you have underlying cost pressures and you can't price your goods to offset that, those are things of recessions, reduced profit margins, right? Falling earnings and so forth. So when we dig deeper below the surface, we see things that just aren't that rosy in terms of, let's say, an equity market outlook. Another thing that kind of speaks to that is we got this nice boost in industrial production, right? Okay, so what does the Fed do with that? On one end, they really want to cut interest rates. On the other end, you've got things like shipping costs and industrial production suddenly showing some life. Okay, so these are noisy numbers, as you can see. So this doesn't defeat or have us rejecting our 6 to 12 month recession outlook necessarily, but it's something not consistent, with a narrative where the Fed would cut interest rates. Now, not that there aren't others, and perhaps the case in point being those retail sales numbers, which actually came out surprisingly strong, certainly surprising to me. And here's what I said on the written blog, and I'm going to close with this. So retail sales surprised to the upside. Indeed, based on what's been reported in retailer earning calls, consumer sentiment, and as of this morning, home builder sentiment, etc., an upside surprise was not on my radar. That said, the upper 50% of income earners are the heavy lifters when it comes to consumption. I chatted with a travel agent friend of mine yesterday, and the vacation business to not cheap destinations is utterly booming. Clearly, the bottom half is suffering, while the top half continues to very much enjoy life. By the way, that is politically problematic, and it's ultimately inflationary if we have to do something about it. So, but then Dave Rosenberg is bearish, granted, rubbing his eyes, and then he looked at the seasonal adjustment. When you don't do the seasonal adjustment, which they do to give you these numbers, it was literally, let's call it 6% plunge in retail sales, the worst rubbing in a decade. And then Peter Berezin, who I have a ton of respect for, he's been really, really good the last few years. Basically, he said that there's just no reasonable, sensible mathematical explanation how that could be that we had the spike in retail sales other than a faulty seasonal adjustment. And he offered up this chart. Here's the seasonally adjusted number, and here's the unseasonally adjusted number. So something weird going on in the calculation here for retail sales this last week. So time will tell. Again, you don't want to put too much emphasis on any one number or any one data point. That's why there's 46 in our own index, and that's why we look at oodles of other stuff as well to form our theses as we go. So folks, I'm going to do a hard stop right there. Hope you guys have a wonderful weekend. I really appreciate you as always for watching and listening, and I'll talk to you again next week. Take care. Bye-bye.